First quarter earnings turned out much better than expected. Almost all the companies in the S&P 500 reported financial results, which grew slightly by 1/10 of a percentage point. And that's much better than the 5% decline analysts expected, according to FactSet. But at the same time, the economic data seen in recent months has been anything but impressive. So what does this divergence mean for investors? Let's bring in Steve Freedman, Senior Investment Strategist at UBS. And Steve, why is there this split emerging? Strong corporate earnings, but weak economic data?
Well, I think what you've seen is that some of the factors that were hurting economic data have actually also been affecting earnings, and in particular the strength of the dollar, which was definitely one of the elements creating the headwinds for GDP in the first quarter. But in the case of earnings, you did have other factors that were successful in really overcompensating that. Clearly, there was some pretty aggressive downward earnings revisions ahead of the quarter, so the bar was set relatively low, but it's undeniably the case that expectations were beat by a very significant margin. On our numbers, it's about 6% upside relative to consensus prior to the quarter. But I think what probably was somewhat underestimated by analysts in their collective wisdom was really the impact, or the positive impact, that lower energy costs would have. Because what you see if you look at the earnings picture is that the bottom line beats by a lot more than the top line. In other terms, it's really the margins that were helpful in creating these beats, and I think some of the energy costs may have been one of the factors helping margins.
All right, so what does all of this mean for investors? Is there a point at which they should take their profits now and run, or get in?
Well, I think it's never black or white, right? And the way we've been approaching the markets since the beginning of the year is we started the year with a relatively constructive view on equities, generally speaking, but the preference was really for the U.S. over other markets. And in the meantime, we've shifted that preference, and we're neutral on U.S. equities, which doesn't mean that we're expecting bad things to happen. We just think that it's going to be returns much more in line with long-term average, so really in maybe the high single digits over a year. But we think that now the more attractive places are abroad. We think that the Eurozone has a lot more potential in terms of its upside relative to the U.S. And this is just because the recovery there is at an early stage, whereas in the U.S. it's a much more mature stage.
And is that also because central bank action in Europe is first heating up, whereas in the U.S. it's winding down?
I think it has something to do with that. It doesn't really stop just with the central banks. It has something to do with the currency impact of central bank policy. So in the Eurozone, you're having the tailwinds from a weaker euro, and you're beginning to see that, whereas in the U.S. it's sort of the other way around. I think financing costs are low in both places. But I think the main thing really for the Eurozone is the potential for earnings, which have been decreasing since the Great Recession. There was a bit of a pickup up to 2011, but after that, when the Eurozone crisis began, it's been a continuous slide. So yeah, there's a significant upside if things normalize, whereas in the U.S. earnings have been growing and are significantly above the pre-crisis levels.
Yeah, and just real quick, sectors you like in both the U.S. and in Europe?
So we have a pro-cyclical positioning in terms of sectors. In the U.S., we like consumer discretionary, we like technology, and we like industrials. And in the Eurozone, where our preferences, we like the consumer sector overall, both discretionary and staples. And we also think that financials have some potential here.
All right, Steve Freedman, thanks very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.